Hey folks, I'm best-selling author of The Power Zero, David McKnight. In today's video, you'll see part 3 of my interview with CFP Adam Olson, in which we discuss the 3 qualities your IUL must have if you want to avoid buyer's remorse somewhere down the road. And when's the best time to use variable loans?
So talk to me about Look Before You Lerp. I loved that book. It's a great resource for people to check out. What are the 8 things that people need to look for if they're doing this life insurance retirement plan where they're putting money into a cash value life insurance product that we're designing for lifetime tax-free income for retirement? What do people need to look for in that product?
Well, you're really putting me to the test here. I got to remember all 8 of those things. I don't know if I can. I don't know if I can crank out all 8 of those, but I'll see if I can basically describe the general premise of the book.
Please.
Basically, what I was trying to do is I was to say, look, people, LIRPs or cash value life insurance only really works if you keep it for your entire life.
Yep.
It's like getting married. In fact, on the cover of that book, you'll notice that there's a couple of wedding rings. In fact, I go through the whole first chapter and I explain in vivid detail exactly why starting a life insurance policy is like getting married. And I tell us the groups full of people, I said, how many of you guys had a laundry list of things you were looking for when you were looking for a spouse? And nobody raises their hand at first. I'm like, come on, you had a laundry list, right? And finally they raise their hands. I'll say, what are the things you were looking for? I want to be attracted to her. Maybe we're going in the same direction. Maybe we're belonging to the same church, whatever. I said, that's exactly right. You had a laundry list of things you were looking for in a spouse because you didn't want to get 10 years into it and realize, we got nothing in common. This isn't really working because divorce is painful, what have you. It is surprising and breathtaking how close a parallel cash value life insurance is to getting married.
Yeah.
Marriage doesn't really work all that well unless it's till death do you part. And cash value life insurance will be the worst investment you ever made if you don't keep it until death do you part. Therefore, the entire premise of the book is if cash value life insurance is like getting married, then you should have a laundry list of things you're looking for when you're considering an IUL. You shouldn't just do it because the guy across the table from you gives you the warm fuzzies or is charismatic or what have you. You should do your research. You don't want to have any surprises. You don't want to have any bugaboos. You don't want to have any skeletons in the closet that arrive right when you need to take the money out, for example. And so I'll give you a couple of those things that I think are absolutely important to have. Number one is you have to have the ability to take a tax-free, which everyone's able to do, tax-free loan, tax-free distribution, but also a cost-free distribution. In other words, how do you take money out of a life insurance policy by way in a tax-free way? Well, basically what you're doing is you're taking a loan and you're using the cash value of the life insurance to collateralize that loan. So just in very, very simple terms, what you do is you call up the company and say, look, I want to take a $100,000 loan, and they won't actually loan you your own money. What they'll do is they'll take $100,000 out of your growth account. They'll put it in what I call a loan collateral account. And they'll say, okay, we're going to tell you that that's going to grow at 3%. And then they will cut you a check out of their own coffers, and they'll call that a loan. So it's an arm's length transaction with the IRS. And they'll say, we're going to charge you 3%. And as long as that 3% number that they're charging you never changes, and as long as that 3% number that they're crediting you never changes, the net result is it's a cost-free distribution from your life insurance policy. Now, I like it. Not all companies do this. I like it when they guarantee the 3% credit and 3% charge. Not all companies do that. If you can get that, that's great. Not necessary, but you want to be able to have a net 0% loan. You want it to be tax-free, which all loans are, but also cost-free. So that's probably the single greatest thing that I talk about having is the ability to be able to take these tax-free, cost-free loans. I also talk about not all 0% loans are created equal. Some companies charge you interest in advance. In other words, they say we're going to charge you interest up front as opposed to interest in arrears. That doesn't seem like a big deal, but when you amortize the effect of that over a lifetime, it can end up adding another 40 basis points to your loan, which and people say, what's the big deal about having a net positive loan? Like what's the big deal about 1% or 2%? Well, guess what? At the end of the year, if you don't pay that loan back, then that interest will be subtracted from your cash value, and that interest continues to grow and compound over the life of the policy. And a 2% loan could end up bankrupting your policy about 18 years faster than you thought. A 1% loan could bankrupt your policy about 11 years faster. So you don't want to horse around with this. And this is why I say, You want to do your due diligence when it comes
Yep.
to these life insurance policies. You don't want to figure out 20 years into it when you're planning on taking money out that you have a 1% or 2% loan. It's got to be a 0% loan. And you got to do enough legwork at the outset to ensure that that's the type of loan provision that's in your policy. And in my book, Look Before You LERP, I go through and I show you how to identify a really lousy loan provision, and I show you how to identify a really good loan provision so that people have a guide as far as that goes. So one other thing that really bugs me about some life insurance companies is particularly when it comes to the IUL, the IUL, you're linking the growth of your money to the upward movement of a stock market index up to a cap. And if you ever lose money, if the index ever goes down in any given year, they simply credit you a 0. Some companies will suck you in with this idea of a high cap, so maybe 13 or 14%. And then once they have you in their clutches, they start to lower it year over year over year. So you want to have a company that has a track record of not just starting you with high caps, but keeping you at high caps. And because, I've seen companies, I've seen the illustrations, I've seen the enforce illustrations that show what happens to your policy if they keep reducing that cap rate over time. So that's another thing that I would say really watch out for. Do your due diligence. See what types of track records these companies have, because remember, it's a 60-year proposition for a lot of people.
Yeah, it's a long time.
Not all policies are created equal.
Yeah. So essentially what the life insurance retirement plan is you're putting the maximum premium in that the IRS allows us. So it's not a modified endowment contract, a MEC contract. So high premium, low death benefit. We're designing it for cash value growth. And then we're going to access that cash value growth via loans in the future, preferably the no cost loans like you just talked about. And then the idea is that that's a great bond alternative for your retirement plan, so that you don't sell stocks when your stock portfolio is down. You sell stocks when the stock portfolio is up. And if the stocks are down, guess what we do? Take it from the life insurance, right?
Exactly. That's exactly
so right. I'm curious, what's your opinion on the indexed loans that people can utilize from IUL, Index Universal Life products? What's your opinion on those?
I think those are good, particularly early on in retirement. They get to be a little problematic later on in retirement. I've seen some of these loan balances in some of these policies where you might have $3 million of outstanding loans, and you only have, say, $400,000 of cash to sustain those loans. Those loans can get pretty big over time. So I just would hate to be in a position where if you don't have growth in a given year and you got $3 million worth of loans and they're charging you 5%, because you get the greater, it's the greater of.
Yeah.
So you don't want to be in a position where you're being charged 5% on a $3 million loan, and it's being that cost is being offset by the $500,000. Now all of a sudden you can go into a death spiral from which your policy never recovers, and then you get that phantom tax bill before you die. You'd be better off never having done the policy. So generally early on in retirement, I'm okay using those loans. Where it's a particularly good time to use those loans is the year after a down year in the stock market. Why? Because what happens to the stock market after it goes down? It typically goes back up. And those are the best. If you could predict every year when the stock market was going to go up, then you would know perfectly when to use the variable loan. Well, you can't do that, but you can get pretty close, because most years when the stock market goes down, it's followed by a year in which the stock market goes up. So if you wanted to play this perfectly, you'd say, okay, I'm going to maybe do my variable loan in the year following a down year in the market, and maybe the fixed loan in the other years. I'd say you could be a little bit more aggressive with the variable loans early in retirement and then play it a little bit more safe later in retirement.
Okay, folks, that was part 3 of my interview with CFP Adam Olson. In the next 10 years, I'm looking to put 100,000 Americans on the road to the 0% tax bracket. If you would like some help implementing a balanced, comprehensive approach to tax-free retirement that shields you from the impact of higher taxes down the road, head on over to davidmcknight.com and click on the Connect with an Advisor button. I'm happy to refer you to an advisor in the Power Zero network that has been trained, vetted, and qualified personally by me. If you're a financial professional and want to learn how to become a certified Power Zero advisor, head over to powerzero.com and opt into my free video series. And if you have any comments or questions, feel free to drop them into the comment section below. I'll respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.